Welcome to today's deep dive into irrational exuberance. I'm your trusted financial advisor, here to demystify this critical concept in finance. Whether you're a seasoned investor or just starting, understanding irrational exuberance can help you navigate financial markets more effectively. Irrational exuberance refers to the overvaluation of assets due to investor enthusiasm and speculative activities. It's a term popularized by former Federal Reserve Chairman Alan Greenspan in the 1990s. Let's break this concept down further. To understand irrational exuberance, we first need to grasp two fundamental ideas: market efficiency and behavioral finance. Market efficiency suggests that all available information is already reflected in asset prices. But human behavior often deviates from rationality, leading to behavioral biases. Let's look at a classic example: the dot-com bubble of the late 1990s. At that time, the advancements in internet technology led investors to pour money into tech stocks, often disregarding the fundamental valuations of these companies. Stocks soared to unprecedented levels before the bubble burst in 2000, leading to massive losses. The essence of irrational exuberance can often be traced back to herd behavior, overconfidence, and speculative mimicking. For example, during the dot-com era, investors believed that every internet company would succeed and deliver high returns. This belief led to excessive investments and inflated asset prices. Now, how can investors identify signs of irrational exuberance? Key indicators include unusually high P/E ratios, skyrocketing asset prices without corresponding earnings growth, and news of speculative investments becoming mainstream. Let's consider this data. In late 1999, the P/E ratio of the Nasdaq Composite Index soared above 200. Compare this with the historical average P/E ratio of the S&P 500, which typically ranges between 15 and 25. This drastic divergence was a clear sign of irrational exuberance. A practical question: how do you manage investments during periods of irrational exuberance? Diversification can be a crucial strategy. By spreading investments across various asset classes, sectors, and geographies, you can mitigate risks related to overvaluation in any single market. Here's a quick example. During the housing bubble of the mid-2000s, astute investors diversified into other asset classes such as bonds and commodities. When the housing market crashed, these diversified portfolios were better positioned to weather the downturn. Occasional checks on economic indicators can also provide foresight into potential bubbles. For instance, trends in GDP growth, unemployment rates, and consumer confidence can serve as early signals of market overheating. Consider the pre-2008 financial crisis period, when the housing market was booming. Indicators like skyrocketing household debt-to-income ratios and highly leveraged financial institutions were red flags pointing towards an imminent market correction. Another question: can irrational exuberance happen in today's market? Absolutely. Even now, we see instances like the surge in cryptocurrencies and meme stocks. While some investments are based on sound fundamentals, others may be driven by speculative fervor. Lastly, it's essential to maintain a balanced perspective. While identifying signs of irrational exuberance is crucial, it is equally important to avoid overreaction. Market corrections are normal, and not every price surge is indicative of a bubble. In sum, understanding irrational exuberance equips you with the knowledge to make informed, rational investing decisions. Stay educated on market fundamentals, practice diversification, and use historical data as a guide. The key is to remain vigilant without becoming excessively cautious or unduly alarmist. Thank you for joining me in this detailed exploration of irrational exuberance. If you found this video valuable, please like, share, and subscribe to our channel for more insightful discussions on finance. Until next time, stay informed and invest wisely.